Here we go again. Are you having fun yet? Well, you will after this lesson because now we get practical. There isn't much need for a consolidated set of financial statements at the date of acquisition. Typically, the first consolidation happens at the parent company's next reporting date. In this lesson, we are going to perform that consolidation. Keep in mind that between the reporting dates, both the parent and the subsidiary keep their own set of accounting records. The parent's investment account can either be carried on its books using the cost method or the equity method. We will perform our first consolidation assuming that the parent company uses the equity method of accounting. Do you remember how that works? Don't worry, we'll have a brief refresher of that as well. So let's get back to our buddy Bob and his next acquisition opportunity. I bet I can guess the name of the target. For those of you who have just joined us midway, Bob owns 100% of Parent Corporation, or PICO. Parent Corporation is in growth mode and is currently pursuing an acquisition strategy. Parent Corporation's latest target is GECO. A deal was reached and a transaction closed on January the 2nd of year one. And under the terms of the acquisition, Parent Corporation purchased 80% of the outstanding shares of GECO for $4,120,000. At the time of acquisition, GECO held patents with a 10-year remaining life, and GECO had recently issued bonds at par maturing in 10 years. Bob was attracted to this business because of its steady cash flow and low risk. The business has consistently delivered $200,000 of net income each year and is expected to continue to do so into the future. The acquisition of GECO looked like this. Parent Corporation acquired 80% of GECO's shares by paying cash of $4,120,000. Parent Corporation now holds GECO shares as a majority-controlled subsidiary with a 20% non-controlling interest held by the previous shareholders. Parent Corporation will have to consolidate GECO in preparing its annual financial statements to comply with GAAP. At the date of acquisition, GECO had assets and liabilities as reflected in this table. The first column summarizes the book value of GECO's assets and liabilities, and the second column summarizes the fair values at the date of acquisition. Of note, the inventory had a fair value in excess of book value by $200,000. The fair value of the patents was higher than the book value by $500,000. The recently issued bonds had a fair value in excess of book value, presumably because interest rates had dropped since issuance, of $300,000. At acquisition, it's necessary to calculate the purchase price discrepancy and allocate it to the assets and liabilities based on the fair value. We start with the cost to acquire the 80% share block, which was the $4,120,000. This implies that 100% of the equity has a value of $5,150,000. We compare this against the existing book values recorded on the books of GECO of $4,500,000, resulting in a positive purchase price discrepancy of $659,000. In other words, Parent Corporation has paid $659,000 more than the net asset value to acquire GECO, presumably because the earnings power or the unrecorded net assets have an intrinsic value not reflected on the books of GECO. The purchase price discrepancy then gets allocated to the identifiable assets and liabilities of GECO that have fair values different than book values. In this case, the inventory, the patents, and the bonds payable. The positive residual of $250,000 represents goodwill. Before we move on, note that we can also calculate the opening balance of the 20% non-controlling interest that was retained by the vendors. Non-controlling interest is valued on the consolidated financial statements on the same basis as the acquirer paid for its majority stake unless fair value information is available to suggest otherwise. Thus, the opening non-controlling interest equates to $1,030,000 on the basis of the implied equity value of $5,150,000. Before we move on to see the business results in the year after the acquisition, let's prepare a schedule to track the reversals impairments, and amortization of the purchase price discrepancy. At the acquisition, the balance shown in the first column originates from the purchase price allocation we just discussed. In the first year, it's commonly assumed that the inventory that was marked up through the purchase price allocation will be sold. This will reduce gross margin in the first year of operations, and beyond the first year will no longer impact equity earnings. The excess fair value increments for the patents will be amortized over the remaining economic life of 10 years. That means consolidated income will be reduced by $50 per year to account for the additional $500,000 of purchase price allocated to the intangible assets at the time of acquisition. The bonds payable had a fair value in excess of carry value at the date of acquisition. This excess or premium will be amortized over the life of the bonds using the effective interest rate method under international standards. This will decrease consolidated interest expense and increase consolidated income by an assumed $30,000 per year. Now, goodwill is not amortized, however, it is subject to an annual impairment test. And in GECO's case, we will simply assume that goodwill was impaired by $25,000 in year 1 and another $12,500 in year 3 for illustrative purposes. Keep the ending balances of the unamortized purchase price discrepancy in mind, as this will factor into the consolidated statement of financial position. In year 1, GECO generated its expected $200,000 of net income. Parent company's entitlement to GECO's net income based on its 80% ownership is $160. Using the equity method of accounting, this will increase the equity investment account. The investment account will also be adjusted for the amortization of the purchase price discrepancy, namely the inventory, patents, bonds, and goodwill impairment. Once again, parent corporation gets allocated 80% of these amounts. Keep in mind that the non-controlling interest will get allocated the other 20%. At the end of year 1, parent corporation's investment account using equity accounting is $4,084,000. In year 2, GECO once again produces net income of $200,000 as a legal entity. Parent corporation picks up its 80% or $160,000 and adds this to the investment account. The remaining purchase price discrepancy is amortized for the patents and the bonds, with parent corporation picking up 80% of this amount as well. This leaves the investment account balance of $4,228,000 at the end of year 2. Year 3 goes by very similar to years 1 and 2. Parent corporation records $160,000 of equity pickup earnings, which is offset by the $26,000 of purchase price discrepancy amortization. At the end of year 3, the investment account balance is $4,362,000 using the equity accounting method. Note that the equity income reported by parent corporation on a non-consolidated basis would be $134,000, which is calculated as the $160,000 of net income pickup less parent corporation's portion of the purchase price discrepancy amortization of $26,000. So let's walk through the consolidation at the end of year 3 to see how both the income statement and the balance sheet come together for the consolidated parent corporation. Presented here are the two non-consolidated financial statements of both parent corporation and GECO. Let's check a few points of reference. First, note within the parent corporation list of assets is the investment in GECO account. The balance of $4,362,000 is the same as we have just finished recalculating, beginning with the purchase price and then adjusting using the equity method for the 3 years subsequent. Second, notice that GECO results do not include the purchase price allocation adjustments. GECO is and has always been a standalone legal entity. PECO's acquisition of GECO 3 years ago created a business combination for accounting purposes only. Thus, we will have to adjust GECO's balances to apply the acquisition cost to the assets and liabilities through the consolidation process. Third, moving to the right-hand side of the screen, notice that the parent corporation is reporting investment income of $134,000. We saw this number earlier as we were preparing our equity method investment continuity schedule for the 3rd year. Fourth, you will see the GCO net income of $200,000. It shows as a negative because it's a credit balance, which in the accounting world represents positive net income. You'll remember that the equity pickup calculation used this amount to adjust the investment account, where 80% or $160,000 was allocated to parent corporation and the remaining 20% was allocated to the non-controlling interest. Finally, take note of parent corporation's net income of $474,000. When using the equity method to account for investments in a subsidiary, there are two golden rules to keep in mind that will help you reconcile your consolidated results. The first is that the net income of the parent will be equal to the net income of the consolidated entity. The second golden rule follows the first in that the shareholders' equity of the parent, both the common stock and retained earnings, will also be the shareholders' equity of the consolidated entity. Let's keep in mind, and this is important, that the objective of consolidating is to replace the $4,362,000 investment in GCO and the $134,000 of investment income with all the individual assets, liabilities, revenues, and expenses and non-controlling interest accounts representing the GCO based on the acquisition price. In other words, we go from what you might think of as a one-line consolidation to a full consolidation. With all this information in mind, let's begin preparing the consolidation. Remember this schedule from earlier? It was used to help us determine the amounts used to adjust the equity earnings from GCO for the items pertaining to the purchase price discrepancy. The columns of relevance for preparing the consolidation are the Year 3 column, which will be used to adjust various revenues and expense accounts, and the balance of the Year 3 column, which will be used to adjust the various asset and liability accounts. The second supporting schedule will be to reconcile non-controlling interest, and let's remember the following. At acquisition, non-controlling interest is valued on the same basis as the new parent's investment, unless there's fair value information available at that time that would separately value the non-controlling interest. Non-controlling interest works like equity method accounting, whereby it picks up its portion of net income as well as its portion of the amortization of the purchase price discrepancy. Non-controlling interest shows as a single line in the shareholders' equity on the balance sheet. On the income statement, non-controlling interest is allocated its portion of the consolidated net income, with the remainder available for the shareholders of parent corporation. In this case, that amount is $33,500. On the statement of financial position, the continuity schedule shows that our non-controlling interest balance at the end of Year 3 should be $1,090,500. The table at the bottom of the slide is proof that this is the right amount. It adds together GCO's legal entity shareholders' equity with the remaining unamortized purchase price discrepancy, which we just separately calculated, and then allocates it proportionally to the non-controlling interest. Lo and behold, two ways to get to the same number. Consolidation accounting is like that. There are a number of ways to get to the right answer, which holds some comfort for the accounting types in our midst. We are now ready to prepare a consolidation worksheet. First, let's start with the statement of financial position. We will begin with the non-consolidated financial statements provided to us for both parent corporation and GCO. Consolidation in its simplest form requires the addition of the assets and liabilities for each entity. This works for each of the accounts: cash, receivable, inventory, plant and equipment, and payables. We then need to eliminate the accounts that don't belong in the consolidation. Keep in mind that the debits must equal the credits as a point of reference. So for instance, we know that parent corporation's investment in GCO goes away, or in other words, is eliminated. We also know that the common stock and retained earnings of GCO, that is the $2 million and the $3.1 million, must get eliminated upon consolidation. Next, we go to the two supporting schedules we have prepared to determine the other adjustments that are necessary. From the purchase price discrepancy schedule, we're able to identify which asset and liability accounts need to be adjusted. The value of the patents needs to be bumped up by $350,000, which represents the remaining unamortized fair value increment that exists from the date of acquisition. Goodwill doesn't exist in the legal entity statements, but on the consolidated financial statements, it must be set up for $212,500, which is the balance remaining after the impairment charges taken during the 3 years subsequent to the acquisition. Finally, the bond payable account needs to be adjusted by $210,000 based on our schedule of the remaining unamortized premium. And finally, to make the journal entry balance, we need to set up another consolidation account for the non-controlling interest of $1,090,500. Review the last column of this table and think through each of the balances reported from a consolidated perspective. If you were looking at parent corporation and GCO as one entity, do these balances make sense? Did the retained earnings of the consolidated entity equal the retained earnings of the parent? They should when the parent has been using the equity method to account for its investment. Now let's look at the consolidated income statement. Once again, in its simplest form, a consolidation should be simply a matter of adding the results of parent corporation and GCO together for many line items on the income statement. And this is true. However, there are a few line items that need further adjustment. The first one is the investment income, which, if you remember, is parent corporation's equity pickup of GCO's reported earnings. So in our consolidation, where we're going from a one-line reporting of the GCO results to a full consolidation of the GCO results, obviously the one-line item gets eliminated as shown in the consolidation column. For the other adjustments, remember to look back at our equity accounting for the GCO results. The equity method analysis helps guide us in converting from the one-line consolidation to the full consolidation. The first adjustment in the equity method accounting was to pick up the earnings of the subsidiary. In PICO's case, this was 80% of $200,000. But don't forget that the non-controlling interest picks up the other 20%. So in essence, the second column in this table, that is GCO's results, includes these revenues and expenses that lead to the $160,000 equity pickup plus the $40,000 of non-controlling interest. We also had to make adjustments for the purchase price discrepancy, which ultimately got reflected in the $134,000. Again, we can return to our schedule of purchase price discrepancy to determine the amounts that need to be reported in the income in year 3. The additional patent amortization gets added to the already reported amortization. The premium amortization reduces interest expense, and the goodwill impairment charge needs to be reported separately. Note these are all reported at 100%. The 20% adjustment of all these amounts is reported in the non-controlling interest allocation of net income. What do you notice about net income? You should notice that both the consolidated income and the parent's non-consolidated net income are exactly the same. This is the simple reconciliation check that helps validate the consolidation when we have a parent that is using the equity method of accounting for its investment in a subsidiary. This obviously won't be the case when the parent uses the cost method to account for its investment. But that's another story. Until then, don't stop till you get to the top. When you get to the top, don't stop.